Before we dive in, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided here is not intended as legal, financial, or insurance advice. You should always consult with a qualified professional for advice tailored to your specific situation. The insurance landscape changes, and while we strive for accuracy, we can't guarantee every detail is current. Your financial decisions are your own, so please do your own research. You just got the email, or maybe it was a letter in the mail sitting there on the kitchen counter. It's from your car insurance company. You open it and your stomach does a little flip. The number. It went up. Again. You haven't had an accident. You haven't gotten a single ticket. Your car is a year older, it's worth less, so why on earth are you being asked to pay more? You feel this wave of frustration, this feeling of being completely powerless. It feels like a subscription you can't cancel, a bill that just decides to grow on its own, and you're just supposed to accept it. To just pay it. Because what's the alternative? Spend an entire weekend calling a dozen different companies, getting bombarded with jargon, and ending up more confused than when you started? It's exhausting. It's confusing. And that is exactly what they are counting on. Insurance companies have a name for this. Some call it the loyalty tax. It's a quiet, unwritten penalty for being a long-term, hassle-free customer. They bank on the fact that you're busy. They know that comparing insurance is a pain, so they slowly, incrementally, raise your rates year after year, hoping you won't notice, or that if you do, you'll decide it's just not worth the effort to switch. They've turned a simple purchase into a complex, intimidating maze designed to make you overpay. But that ends today. This isn't just a video. This is your playbook. This is the decoder ring for the entire car insurance industry in America. We are going to pull back the curtain and expose every single trick, every piece of confusing language, and every hidden opportunity they don't want you to know about. My promise to you is simple. By the end of this guide, you will not only understand how to get a cheaper quote, you will understand how to get the right quote. You will have the confidence to compare policies like a pro, the knowledge to demand the best price, and the power to put hundreds, maybe even thousands of dollars back in your pocket every single year. We are going to embark on a journey together. First, we're going to dissect a car insurance policy piece by piece, translating it from confusing legalese into plain English. You'll finally understand exactly what liability, collision, comprehensive, uninsured motorist, and all those other terms actually mean for you and your money. We'll expose the single biggest mistake people make when they look at their liability limits. A mistake that could financially ruin them even after a minor accident. Then we're going to dive deep into the factors that actually control your price. We'll talk about the obvious ones like your driving record and your zip code, but we're also going to uncover the surprising things that have a massive impact like your credit score, and we'll show you exactly how to manage it to your advantage. You're going to learn about the secret world of discounts. I'm not talking about the obvious safe driver discount. I'm talking about the ones they bury deep on their websites. The discount for your occupation. The discount for the safety features in your car you didn't even know you had. The discount for how you pay your bill. We'll give you a checklist of over 20 discounts you need to ask for by name. We will then guide you through the digital jungle of online comparison tools. Which ones are legitimate, and which ones are just lead generation farms designed to sell your data. We'll show you the right way to use these tools to make companies compete against each other for your business, in real time. Finally, we'll arm you with negotiation scripts. You'll learn the exact words to say to your current insurance company to give them one last chance to keep you as a customer by matching or beating the best offer you found. You will never feel powerless on that phone call again. So let's start with the single most important mindset shift you need to make. We have to stop thinking about finding the cheapest insurance. The goal is not to find the absolute rock bottom price. The goal is to find the best value. A cheap policy that doesn't cover you in a serious accident isn't a bargain. It's a catastrophic liability. It's a piece of paper that gives you a false sense of security right up until the moment you need it most. Value is the perfect intersection of the right coverage, from a reputable company, at the best possible price. And the foundation of all of that, the absolute bedrock of your entire policy, is liability coverage. Liability is not for you. It's for the other guy. It pays for the damage you cause to other people and their property if an accident is your fault. This is the part of your policy that is legally required in nearly every state, and it's broken down into two critical parts. The first is bodily injury liability. Imagine you cause an accident and the people in the other car are hurt. Bodily injury liability covers their medical bills, Their lost wages if they can't work, and even pain and suffering. When you look at your policy, you'll see two numbers for this, something like 50/100. The first number is the maximum amount your insurance will pay for any one person's injuries in an accident. In this case, $50,000. The second number is the maximum amount your insurance will pay for all injuries in a single accident. In this case, $100,000. So if you injure 3 people, your policy will pay out a combined total of no more than $100,000, with no single person receiving more than $50,000. Now let's be brutally honest. Does $100,000 sound like enough to cover a major car accident in today's world? A single night in the hospital, surgery, weeks of physical therapy, that can easily exceed $100,000. And if the costs go above what your insurance covers, guess who they come after for the rest? They come after you. Your savings. Your investments. They can even garnish your future wages. This is why choosing the state minimum for liability coverage is one of the most dangerous financial gambles a person can take. The second part of liability is property damage liability. This one is simpler. It covers damage you cause to other people's stuff. Most of the time this means their car. But it also covers a fire hydrant, a storefront, a guardrail, or a neighbor's fence. You'll see this as a third number, so your liability limits will look something like 50/100/25. That last number means your policy will pay a maximum of $25,000 for property damage you cause in an accident. Again, take a look at the cars on the road today. The average price of a new car is soaring. Can you replace a brand new SUV or a luxury sedan for $25,000? Absolutely not. And what if you're in a multi-car pileup? That's your fault. That 25 grand gets spread thin very, very quickly. Anything above that, once again, comes out of your pocket. Understanding these three numbers is the first step to taking control. They form the shield that protects your entire financial life from one bad day on the road. But that shield, that liability coverage, it's facing outwards. It's designed to protect everyone else from you if you cause an accident. It protects your assets, your savings, your future wages from being seized to pay for the damage you caused. But it does absolutely nothing to fix your car. It does nothing to pay for your hospital bills. If you cause an accident with only liability coverage, you could pay for the other person's brand new Mercedes, but you'll be taking the bus home from the junkyard where your own car was just towed. That's a brutal reality a lot of people face. They get the state minimum, think they're covered, and then discover they only bought half a shield. So, how do you protect your own vehicle? This is where the next two critical pieces of the puzzle come in: collision and comprehensive. Let's start with collision. The name is pretty straightforward. This coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a guardrail, a telephone pole, a garage door you forgot was closed. You get the idea. The most important thing to remember about collision coverage is this: fault doesn't matter. Whether you caused the accident or the other driver did, or it was a hit and run in a parking lot, your collision coverage is what you'll use to fix your car. Now, this coverage isn't free, and it comes with a crucial term you absolutely must understand: the deductible. A deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company pays a single dollar. Think of it like a copay at the doctor's office. You pay the first part and they handle the rest. Deductibles typically range from $250 to $1,000, or even more. Let's say you have a $500 deductible. You back into a pole, causing $2,000 in damage to your bumper. You file a claim. You pay the body shop the first $500, and your insurance company sends them a check for the remaining $1,500. This is where you get your first real taste of customizing your policy and controlling your price. The higher your deductible, the lower your monthly premium will be. Why? Because you're taking on more of the initial risk yourself. You're telling the insurance company, "Don't worry about the small stuff. I can handle a $1,000 repair bill on my own. I only need you for the really big, catastrophic damage." In return, they give you a better price. Conversely, a lower deductible, say $250, means a higher premium. You're paying more each month for the peace of mind that a minor fender bender won't drain your emergency fund. There's no right or wrong answer here. It's a personal decision based on your financial situation. The golden question to ask yourself is, if I got in an accident tomorrow, how much cash could I comfortably write a check for without breaking a sweat? That amount is probably your ideal deductible. Okay, so collision covers you when you hit something. But what about all the other chaos the world can throw at your car? What about a hailstorm that makes your car look like a golf ball? What about a tree branch falling on your hood during a windstorm? What if you walk out of the mall to find your car stolen? None of those are collisions. And that's where the second half of the dynamic duo comes in. Comprehensive coverage. Comprehensive is sometimes called other than collision coverage, and that's a perfect description. It covers damage to your car from just about everything else. Theft, vandalism, fire, floods, falling objects, riots, and one of the most common claims in America, hitting an animal. That deer that jumps out of nowhere on a dark country road? That's a comprehensive claim, not a collision claim. Just like collision, comprehensive coverage has its own deductible, which you can set independently. Maybe you're more worried about a fender bender than a hailstorm, so you set a low $500 deductible for collision but a higher $1,000 deductible for comprehensive to save some money. You have that flexibility. When you hear someone say they have full coverage, this is usually what they mean. It's not an official insurance term, but it's common slang for a policy that includes liability, collision, and comprehensive. It's the trifecta that protects other people, your assets, and your own vehicle. For anyone with a car loan or a lease, full coverage is almost always mandatory. The bank or leasing company technically owns the car, and they're not going to let you drive their asset around without full protection. But even if you own your car outright, if you can't afford to just go out and buy a new one tomorrow, full coverage is something you should seriously consider. Now we need to talk about the single biggest nightmare scenario on the road. It's not just about you causing an accident. It's about someone else crashing into you. Someone who made the irresponsible choice to drive with no insurance at all. Or maybe they have insurance but it's just the bare minimum state liability. They hit you, you're injured, your car is totaled, and their $25,000 policy doesn't even begin to cover your first day in the hospital. What happens then? Do you sue them? You can, but if they don't have insurance, chances are they don't have assets. You can't get blood from a stone. You could be left with hundreds of thousands of dollars in medical bills and a totaled car, with absolutely no way to get it from the person who caused it. This is where the unsung hero of car insurance comes in. Uninsured and underinsured motorist coverage, often abbreviated as UM and UIM. This coverage is so important, yet so many people decline it to save a few bucks a month, without realizing they're gambling with their entire financial future. Here's how it works. If you are hit by a driver with no insurance or not enough insurance, your own UM/UIM coverage steps in and acts like the other driver's insurance policy. It protects you from the irresponsibility of others. It will pay for your medical bills, your lost wages, your pain and suffering, up to the limits you select. There are typically two parts to it. Uninsured motorist bodily injury, which covers you and your passengers, and uninsured motorist property damage, which pays to repair or replace your car if the at-fault driver is uninsured. In some states, your collision coverage would handle the car repairs, but having UMPD can be a lifesaver, especially if you have a high collision deductible, as UMPD deductibles are often much lower. When you get a quote, you'll see limits for UM/UIM that look just like your liability limits, for example 100/300. This means your own policy would pay up to $100,000 for your injuries, and up to $300,000 total for everyone in your car. Given that an estimated 1 in 8 drivers on the road in America is uninsured, this isn't a fringe, what-if coverage. It is an absolutely essential layer of protection for you and your family. Skimping on this is one of the biggest mistakes you can make. Finally, there's one more layer of protection to consider, focused on immediate medical needs. This is medical payments coverage, or MedPay, and in some states a more robust version called personal injury protection, or PIP. Think of this as health insurance specifically for car accidents. It pays for medical expenses for you and your passengers, regardless of who was at fault. If you have to take an ambulance from the scene of an accident, MedPay or PIP can pay that bill right away, without you having to wait weeks or months for the insurance companies to decide who was at fault. PIP, which is mandatory in no-fault states, goes even further, often covering lost wages and rehabilitation services. Even if you have good health insurance, MedPay can be valuable because it can cover your health insurance deductible and co-pays. It's typically very inexpensive to add a few $1,000s of MedPay coverage, and it can provide incredible peace of mind by ensuring immediate care is never a financial question. So now you know the pieces of the puzzle. Liability, the shield that protects your assets from others. Collision and comprehensive, the armor that protects your own vehicle. Uninsured and underinsured motorist, the guardian angel that protects you from the reckless and irresponsible. And MedPay or PIP, the first aid kit that pays for immediate medical needs. These are the building blocks of a solid policy, but the question remains. Why does your neighbor with the same car and the same coverage pay half what you do? The answer lies in a secret score you didn't even know you had, and a dozen other personal factors that insurers are tracking right now to decide if you're a good risk or a bad one. We're about to pull back the curtain on every single one of them. First, let's talk about that secret score. It's officially called a credit-based insurance score. And no, it is not your FICO or Vantage score that you check on your banking app. Think of it more like a hidden cousin to your credit score. It uses information from your credit report, things like your payment history, how much debt you carry, and how long you've had credit, but it runs it through a completely different algorithm. The goal isn't to see if you're worthy of a loan. It's to predict the likelihood you'll file a claim. And here's the kicker that makes people furious. Insurance companies have found a strong statistical correlation between how a person manages their finances and how they manage their driving. According to their mountains of data, people with lower credit-based insurance scores tend to file more claims, more expensive claims, and are even more likely to commit insurance fraud. Whether you think that's fair or not is irrelevant to them. To an insurer, you're not a person, you're a collection of data points, and this score is one of the most powerful predictors they have. So what does it look at? It heavily weights your payment history. A single late payment on a credit card from 6 months ago could be a red flag. It looks at your outstanding debt. Are your credit cards maxed out? That signals financial stress, which they believe correlates to riskier behavior. It looks at the length of your credit history. A longer stable history is always better. It looks at your pursuit of new credit. Applying for 5 new credit cards in a month makes you look desperate and unstable in their eyes. And it looks at your credit mix. Having a healthy blend of different types of credit, like a mortgage and an auto loan, is seen as a positive. Now, before you panic, there are a few critical things to know. First, this practice is banned in a few states. If you live in California, Hawaii, or Massachusetts, they cannot use your credit information to price your auto insurance. Other states like Maryland, Oregon, and Utah have placed restrictions on how it can be used. But for the vast majority of Americans, this secret score is working behind the scenes, silently adding or subtracting hundreds of dollars from your annual premium. Second, an insurance inquiry is a soft pull on your credit, so shopping around for quotes will not hurt your credit score. That is a myth. Get as many quotes as you want. So, the first most powerful factor is your financial DNA. But what comes next? Let's move to the ones you probably already suspect, your personal driving profile. This is your risk resume, and it starts with the most obvious element, your driving record. This isn't just about avoiding tickets. The insurance algorithm is far more sophisticated. It categorizes your violations. A speeding ticket for going 10 miles over the limit is a minor infraction. It'll raise your rates, sure, but it's a slap on the wrist. A DUI, a reckless driving charge, or a hit and run, those are major violations. They are the scarlet letters of the insurance world. A single major violation can make you uninsurable with standard carriers, forcing you into high-risk pools with astronomical premiums for years. The algorithm also tracks frequency. 1 speeding ticket in 5 years is a mistake. 3 speeding tickets in 1 year is a pattern of behavior, and they will penalize you heavily for it. And of course, there are accidents. An at-fault accident where you are deemed more than 50% responsible is a huge red flag. It's direct proof that you cost an insurance company money, and they will make you pay it back, and then some through higher premiums for the next 3 to 5 years. Tied directly to your record are your age and years of driving experience. This is where the statistics get brutal. A 16-year-old male driver is, statistically speaking, the single most dangerous person on the road. The data is overwhelming. Per mile driven, teen drivers are nearly 3 times more likely than drivers 20 and over to be in a fatal crash. As a result, adding a teenage boy to your policy can literally double or even triple your premium overnight. Rates are highest for drivers under 25. Then they begin to drop significantly. They usually bottom out for drivers in their 50s and early 60s, the golden age of insurance rates, before they start to slowly creep back up for drivers over 70, as crash risk begins to rise again. Gender plays a role here too, especially when you're young. Men, particularly young men, pay more than women because statistically, they engage in riskier driving behaviors, get more DUIs, and are involved in more fatal accidents. This gap narrows with age, and in some states like California, Hawaii, Michigan, and a few others, using gender to set rates is illegal. So they've analyzed your financial habits and your personal driving profile. But they're just getting started. The next layer of data is all about where you live. And I don't just mean your state, I mean your specific 9-digit zip code. Your garaging address, the place where you park your car at night, is one of the most influential factors in your quote. Two people with identical cars, identical driving records, and identical credit could live just 5 miles apart in the same city and have a 40% difference in their insurance premiums. Why? Because insurers are analyzing your neighborhood block by block. They are looking at the frequency of theft and vandalism in your specific area. They're looking at population density and traffic congestion. More cars means more chances for accidents. They're even looking at the weather. Do you live in Oklahoma's Hale Alley? Your comprehensive coverage will cost more. Do you live on the Florida coast? Hurricane risk is priced in. Do you live in a dense urban center like Brooklyn? You'll pay far more than someone in a sleepy rural town upstate because of the higher rates of accidents, theft, and even litigation. The cost of car repairs and medical care in your area also plays a huge role. The same bumper repair might cost twice as much in Los Angeles as it does in Little Rock, and your premium will reflect that. Zooming out from your zip code, your state has a massive impact. Each state has its own laws governing insurance. For example, some states are no-fault states, like Michigan and Florida, which means your own insurance pays for your initial medical bills regardless of who caused the accident. This system often leads to higher overall insurance costs. Other states are tort or at-fault states. Each state also mandates different minimum liability coverage limits. A state that requires you to carry very little coverage, like Florida, might seem cheap on the surface, but a state with higher requirements like Maine or Alaska provides you with much better financial protection, and that baseline is reflected in every single quote you get. Okay, so they know who you are and where you are. Now let's talk about what you drive. The make and model of your car is a universe of data unto itself. It's not just about how expensive the car is. A $50,000 minivan could be far cheaper to insure than a $35,000 sports coupe. Insurers look at 4 key things. First, repair costs. A Mercedes-Benz or a BMW has expensive, often imported parts and requires specialized labor, making it much more costly to fix after an accident than a Ford or a Honda. That cost is passed directly to you. Second, theft rates. Every year, the Highway Loss Data Institute publishes a list of the most stolen vehicles. If your car is on that list, and it's often popular, reliable sedans like the Honda Accord or full-size pickups like the Ford F-150, your premium for comprehensive coverage will be higher. Third, safety. Insurers love cars that protect their occupants. They study the crash test ratings from the Insurance Institute for Highway Safety. Cars with high ratings, equipped with features like automatic emergency braking and blind spot monitoring, often earn you a discount because they are proven to prevent accidents and reduce injuries, which saves the insurer money on medical claims. And fourth, performance. A car with a powerful V8 engine is, in the eyes of an insurer, a car that is more likely to be driven at high speeds, and therefore more likely to be in a serious accident. That's why that sensible family sedan costs less to insure than the 2-door muscle car with the same sticker price. Finally, after all that, they look at how you actually use the car. Your annual mileage is a simple but crucial input. The less you drive, the lower the risk. Someone who drives 5,000 miles a year is statistically far less likely to have an accident than someone who drives 20,000 miles a year. They will also ask for your primary use. Is it for commuting to work or school? So, how far? A long daily commute during peak rush hour traffic is a higher risk than someone who uses their car primarily for pleasure driving on weekends. So there you have it. Your credit, your driving record, your age, your location, your car, and your driving habits. These are the core building blocks of every single quote you receive. Insurers feed these dozens of data points into their supercomputers, and out comes a number, your premium. Feels personal, but it's just cold, hard math. They have built a profile of you as a risk. But here's the thing. That profile is based on factors that are largely fixed. You can't easily change your age or your location, and you're not going to sell your car just to save a few bucks. It seems like the insurance company holds all the cards, but they don't, because we haven't talked about the single most important part of the equation yet, the choices you make. The game isn't just about who you are. It's about how you build your policy, and this is where you take back control. Now you know how they see you. But what they don't know is that you're about to use their own game against them. We're about to turn the tables and dive into the specific coverages you need, the ones you absolutely don't, and the secret discounts they don't want you to ask for. Let's start with the absolute, non-negotiable foundation of your policy. This is the stuff that separates a minor inconvenience from a life-altering financial catastrophe. We're talking about liability coverage. Think of this not as insurance for your car, but as insurance for your entire net worth. Your house, your savings, your future earnings, all of it. When you see your quote, it'll be split into two parts: bodily injury liability and property damage liability. Bodily injury, or BI, covers medical bills, lost wages, and pain and suffering for people you injure in an at-fault accident. You'll see it written as two numbers like 25/50. This means the policy will pay up to $25,000 per person injured, with a maximum of $50,000 for the entire accident. Property damage, or PD, is the third number, and it's for fixing or replacing the other person's car. Or, the storefront you just drove through. Now, here is the single most dangerous trap in car insurance: the state minimum. Every state has a legal minimum amount of liability you must carry. And insurance companies will gladly sell you a policy with just the bare minimum because it makes their quote look incredibly cheap. But relying on state minimums is like going into a sword fight with a butter knife. In many states, the minimum for property damage is just $10,000 or $15,000. What happens when your 2012 sedan slides on some ice and taps the bumper of a brand new Mercedes-Benz S-Class? That bumper alone, with all its sensors, can be a $10,000 repair. If you total that car, you're on the hook for $100,000. Your $15,000 policy pays out, and then the other driver's insurance company comes after you personally for the remaining $85,000. They will garnish your wages. They will put a lien on your house. They will follow you for years. Your first step in comparing quotes is to ignore the state minimum. A good rule of thumb for most people is to start at 100/300/100. That's $100,000 per person, $300,000 per accident, and $100,000 for property damage. If you have significant assets, a home, investments, you should be looking even higher, or considering an umbrella policy. This is not an upsell. It is a financial firewall. Next on the non-negotiable list: uninsured and underinsured motorist coverage. This is where you insure yourself against the irresponsibility of others. Nationwide, 1 in 8 drivers is on the road illegally with no insurance whatsoever. In some states, it's as high as 1 in 4. If one of them hits you and puts you in the hospital, their non-existent policy isn't going to pay your medical bills. That's where your uninsured motorist coverage kicks in. It pays for your injuries and your passenger's injuries when the other guy is at fault and has no insurance. Underinsured is similar. It kicks in when the at-fault driver has insurance, but their low-limit policy isn't enough to cover your medical bills. Do not skip this. It is shockingly inexpensive for the peace of mind it provides. Now let's talk about the big two, the coverages that actually fix your car. Collision and comprehensive. This is where the game changes and where you can start to save serious money. Collision covers damage to your car from, well, a collision, hitting another car, a pole, a guardrail. Comprehensive covers almost everything else: theft, vandalism, fire, a tree branch falling on your roof, hitting a deer. The agents will present these as standard. But are they? Here's the secret question they don't want you to ask yourself. What is my car actually worth? Not what you paid for it. Not what you owe on it. What is its actual cash value, or ACV, right now? You can get a good estimate from Kelley Blue Book or NADA guides. Now look at your quote. How much are you paying per year specifically for collision and comprehensive? Let's say your car is worth $3,000. And your quote shows you're paying $800 a year for collision and comp, with a $1,000 deductible. Think about this. If you get in an accident, the most the insurance company will ever pay you is $2,000. That's the $3,000 value minus your $1,000 deductible. But you're paying $800 every year for that potential $2,000 payout. Does that sound like a good deal? Here's a powerful guideline called the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, it's time to seriously consider dropping it. In our example, 10% of the car's value is $300. You're paying $800. It's a bad deal. You are better off self-insuring. Taking that $800 you save and putting it into a dedicated savings account for car repairs or a down payment on your next vehicle. If you have a loan or a lease on your car, the lender will require you to carry these coverages. But if you own your car outright and its value has dropped, this is one of the single biggest ways to slash your premium. Let's move on to the smaller nickel-and-dime coverages. Rental reimbursement. This pays for a rental car while yours is in the shop after a covered claim. Sounds great, right? But look at the cost. They might charge you $60 or $70 a year for it. Do you have a second car in the household? Can you work from home for a week? Could you use a ride-sharing service for a few days for less than $70? For many people, this is an expensive convenience they'll never use. How about roadside assistance? Another $75 a year. But wait, do you have AAA? Does your credit card offer free roadside assistance as a perk? Does your car's manufacturer already provide it? Insurers love selling you this because they know many people are double paying for a service they already get for free elsewhere. Do a 5-minute check. You could save money instantly. Okay, you've stripped down the policy to what you actually need. You've tossed out the expensive, redundant coverages. Now it's time to go on offense. It's time to ask for the discounts they don't just hand out. You have to know they exist. First, the obvious ones. Bundle your auto and home or renter's insurance. It's almost always a significant discount. But don't just accept the first bundle price. Get the standalone auto price first, then ask for the bundle price. Make them show you the math. Now for the ones they don't advertise on TV. Ask for a low mileage discount. With so many people working from home, millions of Americans are driving thousands of miles less per year. If you're driving less than 7,000 or 8,000 miles a year, you are a lower risk and you should be paying less. Tell them your estimated annual mileage and ask for the corresponding discount. Next, the affinity or occupational discount. This is a gold mine. Insurance companies have data showing that people in certain professions get into fewer accidents. Are you a teacher? An engineer? A scientist? A nurse? A firefighter? A member of the military? A government employee? There are dozens of professions that qualify. Don't just tell them your job title. Ask the magic question. Do you offer an occupational discount for your profession? How about your driving habits? Ask if they offer a discount for taking an approved defensive driving course. Yes, you might have to spend a Saturday and $50 on a course, but it can knock 5% to 10% off your premium for 3 straight years. You do the math. Let's talk payment. They love to set you up on a monthly payment plan. Feels more manageable, but they are charging you for it. They call it an installment fee, but it's really just interest. Can be $5, $10, even $15 a month. That's up to $180 a year just for the privilege of paying monthly. Ask for the pay in full price. If you can afford to pay the 6-month premium up front, you can often save over $100 instantly. Finally, vehicle safety features. You probably got a discount for airbags, but did you ask about anti-lock brakes? Daytime running lights? An anti-theft system like an engine immobilizer or a GPS tracker? Go down the list of your car's features and ask, is there a discount for this? Every yes is more money back in your pocket. You now have the blueprint. You know the non-negotiables that protect your entire financial future. You know how to spot the expensive add-ons that you likely don't need. And you have a checklist of hidden discounts to demand. You are no longer just a customer. You are an informed negotiator. You've transformed their complex quote into a simple set of choices where you are in complete control. But knowing what to ask for is one thing. Knowing how to say it, how to frame the conversation, and how to counter their objections when you're live on the phone with a seasoned agent. That is the final piece of the puzzle. And that's exactly where we're going next. Let's be clear. When you pick up that phone, you are entering a game. The person on the other end is a professional. They handle dozens of these calls every single day. They have a script, a system, and a set of psychological triggers designed to maximize the company's profit, not to minimize your premium. They are not your enemy, but their objective is fundamentally different from yours. Your goal is to get the absolute best coverage for the lowest possible price. Their goal is to sell you a policy, often with extras you don't need, at a price point you'll agree to. It's a negotiation, plain and simple. And for the next few minutes, I'm going to give you the playbook. This isn't just a list of questions. This is a conversational strategy, from the first word to the last, designed to shift the balance of power back to you. First, your opening. The first 30 seconds set the entire tone of the call. Most people start weak. They say something like, "Hi, I was just calling to get a quote." The words "just" and "get" immediately signal that you're a passive window shopper. You've handed them control. Instead, you will start with polite, confident authority. Try this. "Hi, my name is," your name. "I'm in the final stages of selecting a new car insurance provider, and I'm calling to get a competitive quote for my 2 vehicles. I have my VIN numbers, driver's license, and current declaration page right here." Let's break down why that works. Final stages of selecting tells them you are a serious buyer, not a tire kicker. This instantly makes you a higher priority. Competitive quote sets the frame. You expect them to fight for your business. And stating you have all your documents ready shows you are prepared, professional, and you respect their time, which in turn makes them respect you. You've transformed from a random caller into a prime customer prospect who is about to make a decision. Next comes the information gathering phase. The agent will start asking you questions. Your name, address, date of birth, the basics. But then they'll get to the more strategic questions. A common one is, and who are you currently insured with? Most people just answer honestly, oh, I'm with Progressive. This is a mistake. Not a fatal one, but a strategic error. The moment you name your insurer, you give the agent a data point. They know roughly what Progressive charges, they know their own company's position against them, and they can start building a sales pitch tailored to beat a specific competitor. You want to maintain control of the information. So when they ask, who are you currently insured with? Your answer should be something like this. I'm with a major national carrier and I've been a loyal customer for several years, but I'm conducting my due diligence this year to ensure I'm still getting the best value. See the difference? You've answered the spirit of the question without giving them specific ammo. You've also subtly hinted that you are a desirable loyal customer type, which every insurer wants. Another key question they'll ask is, and what are you paying right now? Never ever give them the first number. This is negotiation 101. If you say you're paying $150 a month, you have just set your price ceiling. They now know they only need to beat $150 to have a shot. They might have been able to go as low as $110, but now they'll come in at $145 and present it as a huge win. You've left $35 a month on the table. So when they ask what you're paying, your response is, that's exactly why I'm calling. I'm not anchoring my decision to my old rate. I'm looking for the most competitive rate you can offer for this specific level of coverage. This is a polite but firm way of saying, I'm not telling you. Give me your best shot, right out of the gate. Now let's get to the heart of the matter. The discounts. The agent will apply the obvious ones, maybe a safe driver discount, maybe a multi-car discount. Your job is to be a discount archaeologist. You need to dig deeper. You don't ask, are there any other discounts? That's a lazy, closed-ended question. The easy answer is no. Instead, you are going to ask for them by name. You're going to lead the agent through a checklist. Have a notepad ready, and once they give you the initial quote, you begin. You say, okay, thank you for that initial number. Now I'd like to run through a quick checklist to make sure we've applied every possible discount I might qualify for. Can you bear with me for a moment? This frames you as organized and methodical. Then you start. First, let's talk about affiliation. I'm a graduate of your university and a member of an organization like AAA, AARP, or a credit union. Can you check for any alumni or affinity group discounts associated with those? Next, my profession. I work as a teacher, engineer, nurse, scientist, first responder. I know some carriers offer preferred rates for certain occupations. Can you see if my profession qualifies for a discount? Let's move on to payment. Am I receiving a discount for paying the entire premium in full? What about a discount for setting up automatic payments? And are we getting a paperless billing discount? You ask for all three specifically. Now, about the vehicle itself. My car has daytime running lights, anti-lock brakes, an anti-theft system. Can you confirm the passive safety and anti-theft discounts are applied? And finally, usage. I work from home 3 days a week, so my estimated annual mileage is only about 7,500 miles. Can you ensure I'm getting the maximum low mileage discount available? By asking for discounts by name, you force the agent to look them up. You're not asking if they exist. You're asking them to confirm they've been applied. It's a subtle but powerful psychological shift. You're not a supplicant asking for a favor. You're a manager auditing a file. After you've gone through the discount gauntlet, the agent will give you a revised number. This is where the final phase of the negotiation begins. Let's say the new quote is good, but another company's is slightly better. You don't just say, well, Geico is still cheaper. That invites a debate. Instead, you make it about collaboration. You say, okay, we're getting very close. I have a competing quote here for identical coverage. I've checked it line by line. For price, we're only about $12 a month apart. I genuinely prefer the service ratings of your company, and I'm ready to make a decision and sign up right now if we can bridge that gap. Is there any other discretionary adjustment you can make to earn my business today? Let's analyze that phrasing. We're getting very close sounds collaborative. Identical coverage shows you've done your homework. Stating the exact price difference makes the problem seem small and solvable. I prefer your company is a compliment that makes them want to help you. And the magic phrase, earn my business today, creates urgency and empowers the agent. It gives them a reason to go to their manager or look for one last little bit of margin they can shave off. Now, sometimes they'll hit you with an objection. A common one is, well, sir, with that other company, you're getting what you pay for. Our claim service is superior. Do not get defensive. Agree and redirect. Your response: I completely agree that service is critical, which is why I'm leaning your way. And since the coverage levels are identical, my goal is simply to get that price point to a place that makes the decision a no-brainer. Is there anything at all we've missed? Before you end the call, you ask what I call the golden question. Even if you're happy with the price, you ask this: thank you, you've been extremely helpful. Just one final question before I make my decision. Is there any other introductory offer, promotional code, or unadvertised new customer discount that we haven't applied yet? This is your final sweep. It's a low-pressure, catch-all question that costs you nothing to ask and can sometimes save you another 5%. It prompts the agent to check one last time for any temporary promotions or pilot programs you might qualify for. By following this script, you have completely reframed the interaction. You've taken control, demonstrated your expertise, methodically uncovered every available saving, and negotiated from a position of strength, all while remaining courteous and professional. You've given the agent every reason to give you the absolute best rate their system will allow. You now have your rock-bottom, fully discounted quotes from multiple companies. You've played the game and you've won. But here's the frightening truth. The price is only half the battle. The cheapest quote is often a Trojan horse, filled with dangerous exclusions and coverage gaps hidden deep within the policy documents. You can save $200 on your premium, only to find yourself on the hook for $20,000 after an accident because of a single sentence buried on page 27 of your policy. Getting the number is the easy part. Understanding what that number actually buys you. That's what separates a savvy consumer from a future victim. And in the next part, we are going to do something nobody else does. We're going to tear apart a real insurance declaration page, line by painful line, and expose the traps that are waiting for you. Alright, let's do it. This piece of paper, or more likely this PDF in your email, is called the declarations page. It looks boring. It's designed to look boring. It's a wall of text and numbers, and your brain is wired to skim it, see your name, see your car, see the price, and move on. That is a catastrophic mistake. This isn't a receipt. This is a contract that governs your entire financial life. It is the rulebook for what happens when the worst day of your life arrives. And we're going to expose every single trap hidden in plain sight. First, you'll see the basics. The named insured, your address, the policy number, and the policy period. Check these. A simple typo in your vehicle identification number, the VIN, could theoretically give an insurance company a reason to deny a claim. Get it right. But now we get to the heart of it. The coverages. This is where the game is won or lost. The first thing you'll see is liability. This is the coverage that pays for the damage you do to other people. It's not for you. It's for your victims. And it's almost always shown as a series of 3 numbers, like 25/50/25. This is the most misunderstood and most dangerous part of your entire policy. That first number, 25, stands for $25,000. That is the absolute maximum your insurance will pay for any single person's medical bills if you injure them in an accident. The second number, 50, is $50,000. That's the maximum they'll pay for all medical bills in a single accident, no matter how many people you injure. If you hit a family of 4, that 50 grand is all there is to go around. The final number, 25, is $25,000 for property damage. That's for the other person's car, the mailbox you flattened, the storefront you crashed into. Now you might be thinking, well, that's my state's minimum requirement, so it must be enough. That single thought has financially ruined more people than you can imagine. The state minimum isn't a recommendation. It's the legal bare minimum you can have without being arrested. It's like saying the minimum passing grade is a D-. Do you want to build your financial security on a D-? Let's make this real. You're in stop-and-go traffic. You glance at your phone for a split second. Bam! You rear-end the car in front of you. A simple fender bender. Except the car you hit is a brand new Tesla Model Y. The rear bumper alone has ultrasonic sensors embedded in it. The quarter panel is a single piece of stamped aluminum. There's a camera in the tailgate. The repair estimate comes back. It's not $2,000. It's $26,000. Your policy has $25,000 for property damage. You are now personally on the hook for that extra $1,000, plus the cost of their rental car while theirs is in the shop for 3 weeks. And we haven't even talked about injuries. What if the driver of that Tesla gets whiplash? They go to the emergency room. They get an MRI. They need months of physical therapy. Their medical bills hit $35,000. Your policy, with its pathetic $25,000 limit per person, taps out. You are now being personally sued for the remaining $10,000, plus pain and suffering plus lost wages. Your D- coverage just failed. They will garnish your wages. They will put a lien on your house. They will drain your savings. All from a 2-mile-per-hour fender bender. Your 25-50-25 policy is a paper shield against a nuclear bomb. When you see a quote with state minimum liability, you don't see a bargain. You see a trap. A good starting point for liability? At least 100/300/100. A great one? 250/500/250. The difference in premium is often less than a couple of pizzas a month. Next on the page, uninsured or underinsured motorist coverage. UIM. If liability is the shield that protects others from you, this is the shield that protects you from them. Specifically, from the millions of drivers who are illegally on the road with no insurance at all, or the even greater number who have that same worthless state minimum policy we just talked about. 1 in 8 drivers in America is uninsured. 1 in 8. Imagine you're sitting at a red light, and someone plows into you from behind. They're 100% at fault, but they give the police a fake insurance card, or they just admit they have none. Your car is wrecked. Your back is injured. Who pays? You do. Unless you have uninsured motorist coverage. It steps in and acts as the at-fault driver's insurance, paying for your medical bills and your car repairs. Underinsured motorist is for when the person who hits you has that D- policy, and your medical bills are $100,000 but they only have $25,000 in coverage. Your UIM coverage pays the difference. Skipping this coverage to save a few dollars is like playing Russian roulette with your health and your savings. You're betting that the 1 in 8 chance won't be you. Moving on, you'll see either medical payments, often called MedPay, or personal injury protection, PIP. They're similar. This coverage pays for your and your passengers' immediate medical expenses after an accident, regardless of who is at fault. This is the ambulance ride, the emergency room visit, the x-rays. It pays right away, so you're not sitting there with a $5,000 bill while the insurance company spends 6 months arguing about who is at fault. In no-fault states, PIP is often required and is more extensive, even covering lost wages. In other states, MedPay is an optional but incredible peace of mind. $5,000 or $10,000 in this coverage can be a lifesaver. Now we get to the part everyone thinks about, the coverage for your own car. This is split into 2 parts, collision and comprehensive. It's simple. Collision covers your car when you hit something. Another car, a pole, a guardrail. If the accident is your fault, this is the coverage that fixes your car. Comprehensive covers almost everything else. Theft, vandalism, a tree branch falling on your roof, a hailstorm that makes your hood look like a golf ball, hitting a deer, fire, flooding. Think of it as acts of God, or things that happen when you're not even driving. For both collision and comprehensive, there's a key number next to them, the deductible. This is the amount of money you have to pay out of pocket before the insurance company pays a single dime. If you have a $1,000 deductible and you have a $5,000 repair, you pay the first $1,000, and the insurance company pays the remaining $4,000. This is a trade-off. A higher deductible, say $2,000, means you're taking on more risk yourself, so the insurance company will give you a lower premium. A lower deductible, like $250, means they're on the hook for more money, so your premium will be higher. The trap here is choosing a deductible that you can't actually afford to pay. If you have a $1,000 deductible but you don't have $1,000 in your emergency fund, you effectively don't have coverage. You won't be able to get your car out of the shop. A $500 deductible is often the sweet spot for most people. Finally, at the bottom you might see a list of endorsements or riders. These are the little extras. Rental reimbursement, which pays for a rental car while yours is being repaired. Roadside assistance for tows and flat tires. These aren't the main event, but they can be incredibly valuable. Paying $10 every 6 months for rental coverage is a whole lot better than paying $50 a day out of pocket for 3 weeks. So look at this page again. It's not just a list of numbers, it's a series of choices. Each number represents a wall you're building to protect your future. The liability numbers protect your assets from lawsuits. The UM/UIM numbers protect you from the irresponsibility of others. The deductibles determine how much you'll bleed before the help arrives. A cheap quote is almost always a weak wall. And when that 3-ton metal projectile we call a car creates chaos, you'll discover just how weak those walls were, at the exact moment you need them to be the strongest. Now that you can read a single quote, we need to compare multiple quotes side by side, apple to apple. And that's where we'll uncover the next layer of deception companies use to trick you into thinking you found a deal. The first quote that lands in your inbox looks fantastic. Let's call it quote A. It's from a well-known company and the price is, well, it's about what you expected. Maybe a little high, but it feels solid. Then, 5 minutes later, quote B arrives from one of those companies with the catchy commercials. And your jaw hits the floor. $60 a month cheaper. That's over $700 a year. Your mind immediately starts spending that money. That's a new phone. That's a weekend trip. That's a huge chunk of your holiday shopping done. The temptation is overwhelming. You're ready to click buy now and lock in that incredible deal. Stop. Do not click that button, because what you're likely looking at isn't a better deal. It's a better trap. Insurance companies know you're going to scan for one thing first, the price. So they engineer these lowball quotes specifically to catch your eye, betting you won't look any closer. Our job is to call their bluff. We're going to put these two quotes under a microscope, and we're going to do it using a method I call quote normalization. We're not just comparing prices, we're comparing a complex product. The goal isn't to find the cheapest price, it's to find the best value. And to do that, you have to force every quote to play by the same rules. First, print them out. I'm serious. Get physical copies of every quote you're considering, grab a highlighter, and spread them out on your kitchen table. The screen is designed for scrolling and skimming. Paper is designed for scrutiny. We're going to compare 3 core areas: the big 3 coverages, the deductibles, and the add-on coverages. Let's start with the big one: liability limits. Look at quote A, the more expensive one. Probably lists bodily injury liability as $100/300. That's $100,000 per person, $300,000 total per accident. The property damage liability is listed at, say, $50,000. These are respectable, responsible numbers. Now look at the temptingly cheap quote B. You scan the page and find the liability section. And there it is, the first red flag, waving like a matador's cape. Bodily injury, 25/50. Property damage, 25. What you're seeing is the state minimum, the absolute legal bare minimum you can carry to avoid getting a ticket. The insurance company is quoting you the least amount of insurance they are legally allowed to sell. This is the oldest trick in the book. They're not selling you peace of mind. They're selling you a piece of paper that keeps you out of jail. Let's translate what those numbers actually mean in the real world. That $25,000 in property damage? The average price of a new car in America today is over $48,000. You get into a minor fender bender with a brand new Honda Accord, and your insurance might not even be enough to cover the repairs. And we're not talking about a BMW or a Tesla. If you rear-end a new Ford F-150, that 25 grand is gone before the tow truck even arrives. Everything above that comes out of your pocket. They will garnish your wages. They will put a lien on your house. They will drain your savings. All to save $60 a month. And the bodily injury coverage is even scarier. 25/50. Imagine the person you hit has a passenger. They both break a leg. An ambulance ride, an emergency room visit, a few days in the hospital, surgery, physical therapy. One person's medical bills could easily soar past $100,000. Your cheapskate policy covers $25,000. The insurance company writes the check, wishes you the best of luck, and walks away. You are now personally on the hook for the remaining $75,000, plus whatever the second person's bills are. Your financial future could be utterly destroyed because you tried to save the cost of a few pizzas each month. So, the first step in our comparison is to normalize the liability. Go back to the website for quote B and manually change the limits to match quote A, 100/300/50. Then click recalculate. Watch that price jump. Suddenly, that $700 a year gap starts to shrink. Next, we look at the deductibles. This is the amount of money you have to pay out of pocket before the insurance company pays a dime. It's your skin in the game. In our expensive but solid Quote A, the collision and comprehensive deductibles are both listed at $500. That's a very standard, manageable number. If you have a claim, you know your maximum out-of-pocket for repairs is $500. Now let's look at Quote B. You scan the page and there it is. The second trick. Collision deductible, $2,000. Comprehensive deductible, $2,000. A high deductible is a fantastic way for an insurance company to offer a low premium, because it dramatically reduces the odds they'll ever have to pay you anything. Think about it. Most common claims, a cracked windshield, a scraped bumper in a parking lot, a broken side mirror, often fall under that $2,000 mark. So you're paying for insurance every single month that you can't even use for the most likely types of damage. You back into a poll and get a quote for $1,500 in repairs? Too bad. That's all on you. You're essentially self-insuring for any damage up to $2,000, while still paying a company for the privilege. So step 2 of normalization, go back to that online form for Quote B. Change both deductibles from $2,000 down to $500 to match Quote A. Click Recalculate. Poof! That price difference just got even smaller. Now for the third and most insidious part of the comparison, the optional coverages. This is where companies really gut a policy to make it look cheap. Let's go back to our respectable Quote A. We see line items for uninsured/underinsured motorist coverage, matching our liability limits of $100/300. We see rental reimbursement at $40 a day. We see roadside assistance. We see medical payments coverage of $5,000. It's a complete package. Now we look at the cheap Quote B, after we've already adjusted the limits and deductibles, and we see a lot of empty space. The uninsured motorist coverage is there, but it's at the state minimum of $25.50, not the $100/300 we want. There's no rental reimbursement, no roadside assistance, no medical payments. They have stripped this policy down to the bone. Let's be crystal clear about what this means. 1 in 8 drivers in this country is uninsured. That's a terrifying statistic. If one of them plows into you and puts you in the hospital, your health insurance will help, but what about your lost wages? Your pain and suffering? Your long-term care? That's what uninsured motorist coverage is for. It protects you from the irresponsibility of others. Skimping on this is like playing Russian roulette every time you get on the highway. And rental reimbursement? It sounds like a luxury, until your car is in the shop for 2 weeks after an accident. Suddenly you're shelling out $500, $600 just to get to work. That $60 a month you save looks pretty foolish when you're hit with a massive, unexpected rental bill. Roadside assistance is the same story. It's pennies a day on your policy, but a single tow can cost you hundreds of dollars. So, for our final normalization step, we go back to the Quote B website one last time. We increase the uninsured motorist coverage to $100/300. We add rental reimbursement at $40 a day. We add the roadside assistance package. We add $5,000 in medical payments. We have now perfectly mirrored the coverage offered in Quote A. We have made it a true apples-to-apples comparison. And now we click Recalculate for the final time. And the truth is revealed. The $60 a month cheaper quote is now $10 a month more expensive than Quote A. The incredible deal was an illusion. It was a phantom, built by stripping out vital protections and hoping you'd be so mesmerized by the initial price that you'd never notice. This is the process you must follow. Every single time, you normalize the quotes so that the coverage, the limits, and the deductibles are identical. Only then can you truly compare the bottom line price. You'll often find that the company that gave you a responsible, honest quote from the start is actually the one offering the better value. They weren't trying to trick you, they were trying to properly protect you. But let's say you do this and you have 2 or 3 quotes that are now identical in coverage and very close in price. How do you choose? Now the real work begins. Because the policy itself is only half the product. The other half, the part you don't see until it's too late, is the company behind it. Their financial stability, their customer service, and most importantly, their reputation for actually paying claims without a fight. And that invisible factor is where the best and worst companies are truly separated. So how do you investigate this invisible factor? How do you look under the hood of an insurance company to see if the engine is actually built to last? Or if it's just a shiny exterior hiding a lemon? You become a detective, and you have 3 primary clues to follow. their financial report card, their public satisfaction scores, and the unfiltered word on the street. Let's start with the most critical, the bedrock of it all, financial strength. An insurance policy is at its core a promise. It's a promise that if something catastrophic happens, the company will have the cash on hand to make you whole. But what if they don't? What if a massive hurricane hits a coastal state, or a series of devastating wildfires sweep through a region, and your insurer has to pay out billions of dollars in claims all at once? If they haven't managed their money properly, they could literally go bankrupt, leaving you with a worthless piece of paper and a wrecked car. This isn't just a theoretical scare tactic. It has happened. That's why independent rating agencies exist. Think of them as the credit score agencies for insurance companies. The most respected names in this space are AM Best, Moody's, and Standard & Poor's. Their entire business is to analyze the financial health of these insurers, their cash reserves, their investment strategies, their debt, and assign them a grade. This grade tells you, the consumer, their ability to pay claims, especially during a crisis. For our purposes, AM Best is often considered the gold standard for the insurance industry. They use a simple letter grade system much like school. An A++ or an A+ is considered superior. An A or A is excellent. These are the A students. They have a massive financial cushion and a long history of meeting their obligations. A B++ or B+ is good. Anything below that, you should start to get very, very cautious. You should never ever sign a policy with a company that isn't rated at least an A- by AM Best or an equivalent high rating from Moody's or S&P. Think of it as a non-negotiable prerequisite. A super low quote from a C-rated company isn't a bargain. It's a gamble. Huge one. And you can find these ratings for free. Just go to the AM Best website, type in the insurer's name, and see their report card. Takes 30 seconds and it could save you from financial ruin. Make this the very first check you run on any company that gives you a quote. If they don't pass, the quote goes straight into the trash, no matter how cheap it is. Okay, so the company has the money. That's step one. But will they actually give it to you when you need it? This brings us to our second clue: customer service and claims satisfaction. This is where we separate the companies that treat you like a valued partner from those that treat you like a costly annoyance. Here, our two best friends are J.D. Power and the National Association of Insurance Commissioners, or the NAIC. J.D. Power is a name you've probably seen on car commercials. They are a massive data and analytics firm that conducts huge, nationwide studies on customer satisfaction across different industries. For auto insurance, they have several key reports each year. They rank companies on the shopping experience, the billing process, and most importantly, the claim satisfaction experience. Their rankings are usually presented region by region, so you can see who the top performers are right in your area of the country. They use a simple 5-point scale, often shown as power circles. 5 circles is among the best, 4 is better than most, 3 is about average. You're looking for companies consistently scoring 4 or 5 circles, especially in that all-important claims category. This tells you that, on average, their customers have a smooth, relatively painless experience when they actually have to use the product they paid for. But we can get even more granular. We can get more objective. And for that, we turn to the NAIC. This is arguably the most powerful tool the average consumer has, and almost no one knows about it. The NAIC is the organization of state insurance regulators, and they track all formally filed complaints against every insurance company. From this data, they create something called a complaint ratio, or a complaint index. Here's how it works, and it's brilliant in its simplicity. The NAIC calculates the national median number of complaints an insurance company should get, based on its size. They set this median at a baseline of 1.00. If a company has a complaint index of 1.00, it means they receive an exactly average number of complaints for a company of their size. If their index is 2.00, it means they receive twice as many complaints as they should. If their index is 0.50, they receive only half as many. This is pure, unadulterated data. It's not about feelings or surveys. It's about the number of people who were so frustrated with their insurer that they took the formal step of filing a complaint with a government regulator. A company with a consistently high complaint index, anything significantly above 1.00, is waving a giant red flag. It's a mathematical signal that there's something wrong with their process. Maybe they lowball their initial offers, maybe their adjusters are impossible to reach, maybe they drag out payments for months. Whatever the reason, a high NAIC complaint index is a sign of trouble. You can look this up for free on the NAIC website. Again, it takes less than a minute. Financial stability and official complaint data are the hard numbers. They're the foundation of your investigation. But now it's time for our third and final clue: the word on the street. This is where you put on your boots-on-the-ground reporter hat and dig into what real people are saying in the real world. Now, a word of caution here. Online reviews can be a minefield. Unhappy customers are 10 times more likely to write a review than a happy one. So if you just go to a generic review site, you're going to see a wall of negativity for almost every company. You need to be smarter than that. You're not looking for individual horror stories. You're looking for patterns. Is every other complaint about the exact same issue? For example, does everyone say Company X's app is unusable? Does every negative review for Company Y mention that their adjuster stopped returning calls after the first week? Do dozens of people complain that Company Z tried to force them to use non-original manufacturer parts for repairs? These patterns are the signal in the noise. One person's bad experience could be a fluke. 50 people having the identical bad experience is a systemic problem. So where do you look? Start with the Better Business Bureau. Look at their rating, but more importantly, read the actual complaints filed. Check out online forums like Reddit. There are subreddits like r/insurance where you can search for a company's name and see unfiltered discussions from actual customers and even industry insiders. You'll often find far more nuanced and detailed information there than on a simple review site. By combining these three elements, the financial report card from AM Best, the satisfaction and complaint data from J.D. Power and the NAIC, and the anecdotal patterns from real-world reviews, you can build a comprehensive profile of any insurance company. You can move beyond the price tag and understand the actual value of the promise they're selling you. You might find that the company with the absolute rock-bottom price has a B+ financial rating, a 2.5 NAIC complaint index, and a sea of reviews complaining about slow payouts. Is saving $30 a month worth that risk? On the other hand, the quote that was second or third cheapest might be from a company with an A++ rating, a 0.6 complaint index, and glowing reviews about their claims process. That isn't just a policy. That's peace of mind. And that is what you're truly shopping for. You've now learned how to vet the policy and how to vet the company. You're armed with more knowledge than 99% of the people buying car insurance. But what if I told you that even after all this, there's a secret layer of savings most people miss? Discounts that aren't always advertised, but can slash your premium by hundreds of dollars if you just know what to ask for. That's where we're going next. Think of it like this. When you get an online quote, the system only asks you the basic questions. It's programmed to give you a standard price. But an insurance company has a whole playbook of discounts, a thick binder of ways you can save money, and the online form barely scratches the surface. Getting access to that playbook requires a human conversation and the right magic words. Let's break down this secret layer of savings into three main categories: discounts about you, the driver, discounts about your CAR, and discounts about your policy itself. First, let's talk about you. Insurers are obsessed with one thing: risk. The less risky you appear, the less you pay. So what makes you look like a safe bet? Well, being a good student is a big one. If you or a driver on your policy is in high school or college and maintains a B average or better, that's often worth a 15 to 25% discount. Why? Because the data shows that students who are responsible in the classroom tend to be more responsible behind the wheel. But you have to ask for it. Don't assume they know your kid is on the honor roll. You need to explicitly say, "My son is a full-time student with a 3.2 GPA. Does that qualify him for the good student discount?" Next up is the defensive driving course. This is one of the easiest and most overlooked ways to save money, especially if you have a recent ticket. Completing an approved defensive driving course can knock 5 to 10% off your premium for 3 years. The insurance company sees it as you actively working to become a safer driver. You're investing your time, so they'll invest in you with a lower rate. Again, you must be proactive. Call them and ask, "If I complete a state-certified defensive driving course online, what percentage discount will that apply to my policy?" But here's the one most people have no idea about: affinity discounts. This is the gold mine. Insurance companies partner with thousands of organizations to offer special rates to their members. Are you a member of a university alumni association? There's a discount for that. Are you a teacher, a nurse, an engineer, a first responder, or a member of the military? There are massive discounts for that. Do you belong to a specific credit union, a wholesale club like Costco or Sam's Club, or even a professional organization related to your job? Chances are there's a discount waiting for you. This isn't a small thing. These can be significant 10, 15, even 20% savings. You have to treat this like a treasure hunt. Make a list of every group, organization, and association you belong to. Then, when you're on the phone with an agent, you go down the list. Do you offer a discount for members of the American Nurses Association? What about for graduates of Ohio State University? Don't wait for them to ask you. Most won't. You have to bring the information to them. Now let's move on to the second category, your car. The vehicle itself is a huge part of the equation, and it comes with its own set of hidden discounts. The most common are for safety and anti-theft features. Does your car have anti-lock brakes, daytime running lights, or electronic stability control? Those are all potential discounts. Does it have a factory-installed alarm system, or a passive disabling device that prevents the engine from starting without the key? That's another discount. These might seem small, maybe a few percentage points each, but they add up. The key is to know what your car has. Don't just say, it has an alarm. Say, it has a passive, factory-installed anti-theft system. The more specific you are, the more likely you are to trigger the discount in their system. Another big one is the new car discount. If your car is less than 3 years old, you may be eligible for a discount of up to 10%. The logic is that newer cars have more advanced safety features and are generally more reliable, making them less of a risk to insure. And here's a pro tip related to your vehicle. Think about your VIN. That's your vehicle identification number. When you get a quote, make sure they are using the full correct VIN. This number tells the insurance company everything about your car, down to the specific safety features it was built with at the factory. Sometimes, a generic quote based on just the make and model will miss out on features that could save you money. Providing the VIN ensures you're getting a quote for your exact car, not just one like it. Finally, we have the third category. Discounts related to your policy itself. This is where you can get really strategic. The most well-known discount here is bundling, or the multi-policy discount. If you have your home or renter's insurance with the same company, they will almost always give you a substantial discount on both policies, often between 10 and 25%. It's one of the single biggest discounts available. They're rewarding you for your loyalty and for giving them more of your business. But don't stop there. How you choose to pay can also unlock savings. Ask about the paid in full discount. If you can afford to pay your entire 6-month or 1-year premium upfront instead of in monthly installments, companies will often give you a discount. This is because it saves them administrative costs and eliminates the risk of you missing a payment. It's a simple win-win. Similarly, ask about going paperless. Agreeing to receive all your bills and documents electronically saves the company printing and mailing costs. They'll often pass a small piece of that savings back to you in the form of a discount. It's not huge, but why leave money on the table? And then there's the loyalty discount. If you've been with your current insurer for several years, make sure you're getting credit for it. But here's the twist. You can leverage this even when you're shopping around. When talking to a new potential insurer, you can say, I've been with my current company for 5 years with no claims. Loyalty is important to me. What kind of loyalty program or long-term customer benefits do you offer? This signals that you're a desirable, stable customer, not someone who will jump ship in 6 months. Now there's one more major discount category that's a bit more controversial, and that's usage-based insurance or telematics. This is where you agree to let the insurance company monitor your driving habits, either through a small device you plug into your car or a smartphone app. It tracks things like how many miles you drive, what time of day you drive, your speed, and how hard you brake and accelerate. If you are a genuinely safe, low-mileage driver, this can lead to massive savings. We're talking up to 40% off in some cases. It's the ultimate way to prove you're a low-risk driver. However, it's a double-edged sword. There are privacy concerns as you're handing over a lot of personal data. And if it turns out your driving habits aren't as perfect as you think, it could potentially lead to your rates going up in the future. My advice is to consider this option carefully. If you work from home, have a short commute, and are confident in your safe driving, it could be a game changer for your premium. So let's put it all together. You've gotten your initial quotes. Now you get on the phone. You have your list. You ask about the good student discount, the defensive driving course, and your list of affinity groups. You confirm they have all your car's safety and anti-theft features logged correctly. You ask about the multi-policy discount, the paid-in-full option, and the paperless discount. You inquire about their telematics program. You are no longer a passive customer accepting the first price they offer. You are an active, informed consumer, methodically unlocking every single dollar of savings you are entitled to. By the time you're done, the quotes you're holding could look drastically different and drastically lower than the ones you started with. You've peeled back the standard price and accessed the real discounted price that's reserved for people who know the right questions to ask. But now comes the final, most crucial step. You have 3 quotes in front of you, all fully loaded with every discount you qualify for. One is from a giant national brand, one is from a smaller regional company, and one is from an online-only startup. The prices are close but not identical. How do you choose? It's tempting to just grab the cheapest one and call it a day. But that could be the single biggest mistake you make. Because the price of a policy is only half the story. The other half, the part you only experience when things go wrong, is what truly defines a good insurance company. And that is what we need to break down next. So let's talk about the moment of truth. Because that's what a claim is. It's the one moment where your insurance company has to prove that all those monthly premiums were worth it. It's the moment the abstract promise on a piece of paper becomes a real, tangible action that affects your life, your finances, and your stress levels. A low price is fantastic until you're sitting on hold for 45 minutes, getting transferred between departments, fighting with an adjuster who's lowballing your car's value, and waiting weeks for a check that should have been there in days. Suddenly, that $200 you saved over the year feels like a terrible, terrible trade. So how do you judge a company's character before you have a crisis? You look at their track record. You check their report card. And luckily for us, there are independent organizations that spend all year grading these companies on exactly this. The 2 heavyweights you need to know are J.D. Power and Consumer Reports. Let's start with J.D. Power. You've probably seen their awards on car commercials, but their most important work for us is their annual U.S. Auto Claims Satisfaction Study. This isn't some vague survey. They break down the entire claims process into key stages. First, the first notice of loss. How easy was it to actually report the accident? Were you met with a simple app and a compassionate human? Or a confusing phone tree and endless hold music? Then they look at the claim servicing, the communication from the adjuster. Did they keep you in the loop? Or did you have to chase them for updates? They score the estimation process. Was the initial damage estimate fair and accurate? They look at the repair process itself. Did the company work well with your chosen body shop? And finally, and most critically, the settlement. Did you feel the final payout was fair for the value of your vehicle or the cost of repairs? A company that scores highly across all these categories in your region is a company that has invested in making a horrible experience as painless as possible. A company that consistently scores low is showing you, in bright neon letters, that their priority is saving money, not serving you in a crisis. Then you have Consumer Reports. Their power comes from the fact that they survey their own massive base of readers, real people who have actually been through the claims process. They ask them a simple, powerful question. Overall, were you highly satisfied? They collect tens of thousands of these real-world experiences and distill them into ratings. What I love about their data is that it cuts through the corporate marketing and gets right to the heart of the customer experience. You don't have to pay for these full in-depth reports. News outlets report on the results every single year. A simple search for J.D. Power Auto Claims Satisfaction Study or Consumer Reports Best Car Insurance will give you the latest rankings. Spend 30 minutes with this data. See who consistently lands at the top of the list and who is always stuck at the bottom. This is your first and most powerful filter to separate the contenders from the pretenders. Next, you need to assess their financial strength. This sounds boring, but it is fundamentally important. An insurance policy is only as good as the company's ability to pay its claims. You want a company that is a financial fortress, not a house of cards. Imagine a massive hurricane hits a coastal state. Hundreds of thousands of claims pour in all at once. A financially weak company could be overwhelmed, delaying payments or even going broke. A strong company will have the deep cash reserves to handle that catastrophe and still pay your claim for a fender bender 1,000 miles away without breaking a sweat. So how do you check this? You look at ratings from independent agencies like AM, Best, Moody's, or Standard & Poor's. The most common one you'll see is AM, Best. They grade companies on a scale much like a school report card. An A rating, which includes a plus, A, and A, means the company has an excellent or superior ability to meet its ongoing insurance obligations. In simple terms, they are rock solid. You should be very hesitant to sign up with any company that has a B rating or lower. Their website lets you look up any insurer for free. It takes 2 minutes and it gives you a peace of mind that is priceless. finally, after you've checked their claims reputation and their financial stability, you need to do a real-world test drive of their customer service and technology. In 2024, a company's mobile app is a huge part of the experience. Download the app for the 2 or 3 companies on your shortlist. Can you easily access your insurance ID card? Is the interface for starting a claim clear and simple? Does it have a button for one-touch roadside assistance? A clunky, outdated app is often a reflection of a clunky, outdated company. And then, do something almost nobody does. Call them. Call their customer service line with a simple question. Maybe ask about a specific coverage detail or a discount. The goal isn't just to get the answer. The goal is to experience their system. How long did you wait on hold? When you got a person, were they knowledgeable and helpful, or were they just reading from a script? This 5-minute phone call can tell you more about a company's culture than any commercial ever will. So now you have everything. You've gathered your quotes. You've made sure the coverage levels are identical. You've researched the claim satisfaction ratings. You've verified their financial strength. And you've done a quick test of their service. It's time to put it all together. Don't just look at the list and pick the cheapest one. Look for the sweet spot. Look for the best overall value. Maybe Company A is the cheapest by $15 a month, but they have mediocre claims ratings and AB+ financial score. Company B is a little more expensive, but they are a perennial J.D. Power winner, have an A+ rating from AM Best, and their app is a dream to use. Which one is the better deal? It's Company B, and it's not even close. That extra $15 a month is you buying certainty. It's you buying peace of mind. It's you buying a promise from a company that has proven time and time again that they will actually be there for you when you need them most. This is the final step. It's where you move from being a price shopper to a value investor. You're not just buying a product. You're hiring a company to protect your financial life. Over these 10 parts, we have taken a journey. We started by decoding the complex language of liability, collision, and comprehensive. We uncovered the hidden discounts that companies don't always advertise. We learned the strategies to optimize your deductible and coverage limits. We navigated the world of online comparison tools and local agents. And now we've learned how to look beyond the price tag and judge the true quality of an insurer. You are now armed with more knowledge than 99% of the drivers on the road. You have the power to walk into this process not with confusion or anxiety, but with confidence and clarity. You understand that the goal isn't just to find the cheapest policy. The goal is to find the right protection from the right company at the best possible value. You are buying a promise that if the worst day happens, if you see flashing lights in your rearview mirror and the sickening crunch of metal, that you made a smart choice months or years earlier. A choice that will make that horrible experience just a little bit easier to bear. So take this knowledge, use it, build your comparison, check the report cards, and make your choice with confidence. Go find not just a cheaper policy but a better promise.